And toasty day here in Las Vegas. I don't know where you're joining me from, but today I have a very special update. June 26, 2020. We have some additional items to add on today, which are some special tax and investment reports and some additional webinars that I've just scheduled because these things that I just uncovered are going to be needed to be explained in much greater detail than just a short monthly or a short weekly update. So let's get on with today's quick update. Economic indicators, as we've covered each week now for the last 4 months: unemployment, Fed decisions, interest rates, housing, inflation, and stock market indexes. Today we're going to add on a special investment update. Now, for a lot of people that ask me, they'll say, well, which way do you think that the stock market is heading, and what way do you think that the bond market is heading? Look, nobody has a crystal ball. But here's the problem that most people have. They turn to all of these resources like Morningstar or Lipper or whatever it might be. And that's like looking in the rearview mirror. You're going to read something that some analyst is going to predict based upon what a company's earnings were the last 6 months or last year. There is absolutely no, in this kind of environment, there is no ability to say to this analyst, hey, this is a great stock or a great bond. So I'm not putting a lot of credence in what analysts say. Don't forget, back in 2008, all of the analysts were saying this stock market will continue, it'll never go down, right? All of the real estate analysts were saying, oh, it'll never go down. So I've never put a lot of credibility in the analysts, right? Because again, who do they work for? They work for either a company that is getting money from advertisers, i.e. a lot of the analyst companies, or from the mutual funds themselves, or they work for some of the big institutions. So there's a lot of back-end stuff that I don't really trust. What I do trust, though, is what Warren Buffett says. He says, watch the birth rates, watch the housing, watch what things are trending. I'm going to steal a very popular saying from Wayne Gretzky, who was still, in my heart, is still the all-time best hockey player of the universe. And he would always say, well, he was asked why he was so successful. And he said that most hockey players would skate to where the puck was. He would visualize where that puck was going, and that's where he would skate towards. Unfortunately, when people use star ratings and analyst ratings and past PE ratings or ratios, you're all looking to where the puck has already been. So we have to look ahead. And that's why today we're going to do a special investment update and give you what we see these economic indicators are heading towards. And you know, you don't need a crystal ball to align certain things up. While I can't tell you what the exact price of something is going to be, when you have unemployment figures, when you have Fed decisions, when you have elections, and these things you can plan for. Now, while we don't know who will win the election, what we can do is we can plan for either or, right? We can make contingency plan Bs for if the Democrats get in, because that will change the way that investments in stock markets work. So before I get started on today's real quick update, I wanted to tell you that I have not done a webinar in probably about 60 days, and mainly because the amount of time it was taking me personally to build these algorithms, watch the indicators, restructure the portfolios, work with the clients on Roth conversions, going back into the RMDs and figuring out all the strategies. But now I'm seeing this divergence of this algorithm into a whole different realm that I need to overlay and bring out this to everybody. So I'm going to do some more webinars. Hey, here's how you find out about the webinars. What you do is just go to your web browser, just click in. Whoop, I went a little too fast. Let's try that again. Go into web browser, click hhrdm.com, hhrdm.com, and you'll see on the web page in the far right-hand side, there's a More button. If you click on live broadcast, that's what you're getting today. But click on webinars, and you're going to see the upcoming webinars that we're doing. All you do is click on the one you want, put your time zone in, and put your name and your email in, click register. And unfortunately, we are limited based on our technology and we are limited to the first 200 people that register. So if unfortunately there is, and in the technology today, there's actually no wait list like we would have if we were doing a seminar. So the faster you get onto that thing and register for the things that you want to learn about to protect and preserve and possibly even grow your assets in this environment, click on that to find out more. Now, we're going to do a little adjustments here because, again, I'm seeing some divergences in our original algorithm and what we need to overlay based upon some things with taxes, the election. As far as the original economic mapping that I did back in February, nothing has changed in that mapping as it applies to the virus. And as you remember, I had said over and over again, I've been through, I don't know, 5 or 6 of these crashes, and this is, from my perspective, one of the easiest ones to predict because it's based upon a vaccine. So we're following the 22 different companies that are developing the vaccines, what their deployment date is, where people are in the resurgence of that virus, where is the re-employment. So let's go back through this, and I'm going to kind of give you an update. For those of you that are joining this for the first time, hopefully this will make sense. And if you're joining me for the first time, real quickly, what this is, it's an economic map. It takes all the different factors that are happening within our macroeconomics, and it puts them into a what-if scenario. Like we run, if you have a financial plan, we run a what-if scenario. So this is running that what-if scenario. So originally, back in February, when this virus reared its ugly head, we saw that institutions started selling. And when we saw this, we started looking at what was happening with the public. And unfortunately, today, big institutions have something called big data. Big data, or big data, however you want to say it, Nevada, right, is the ability for a large institution is to collect general feelings, consensus, economic indicators, and then they can make financial decisions. Well, today, believe it or not, a lot of that big data in determining what an institution does with buying or selling has to do with social media. They can read, their big data computers can read every post. They can figure out what people are doing, what stocks they like, what stocks they don't like, what their general consensus is, are they nervous? And so what they do is they start selling in advance of what they're reading, right? So what then happens is the typical retail consumer investor starts seeing the market crash. Why? Because the institutions are pulling out. Remember, they're playing games here. This is all just a big chess game. And then what happens is the market dumps. Well, the virus steps in, and all of a sudden, as you see there in that yellow line, every state freezes, and no one has, the people start getting laid off. People can't go to work, they can't use their offices, no restaurants are open, right? We saw that. And then that even accelerates the consumer selling even more. So in March, we saw a stock market that dropped 30 to 40% in some cases, depending upon what you were invested in. I had originally made the economic mapping that once the virus levels started to level out, and we saw them leveling out with the stay-at-home rules, and we anticipated the resurgence, right? So we said that when businesses reopen, employment will increase, right? But we're going to have this spending spree and confidence where people just want to get out, right? This, and listen, if you're listening to this for the first time, it might sound like, well, it's easy to do this now. We can look back at as exactly what happened. Well, I can tell you to go back to my hhrdm.com YouTube channel. Look back at the original one of these economic mappings that I did back in the beginning of March, and you're going to see the same exact thing. This isn't something that I created after the fact. This is a lot of number crunching. This is a lot of algorithms, and I can't take any credit for this, to be honest with you. The firm that I worked with for 9 years, they had an entire institutional division that what they would do is economic mapping, and I got to watch it firsthand on when crashes would happen. Now back then they didn't have big data, but they'd use the Wall Street Journal, and one of these days I'll tell you some of the things that I've heard about where people would hire lip readers and psychologists to sit outside the government offices, so when the feds or FOMC would meet and they would try to read the words between the different members as they were coming out. And back in the 80s, that's what you would consider big data, right? Today, it's just some big giant computer that measures all the social media posts, right? Well, anyway, what I said is that the market would surge upwards, but we are going to see a downturn. Now, again, a lot of people will step back and say, Ken, should I pull out of the market? Should I buy into the market? No, listen, this is not day trading, and this is not necessarily market timing. We can never predict on a daily basis. I mean, for goodness sakes, Chairman Powell could come out on TV and say one negative word and it sends everybody into a tiz. Now, you got to understand that there's these domino effect. So when the Fed says something negative, you get the little retail investors, like the Robinhood investors, and they're going to start selling something. And then the algorithms will kick in on the computer automated selling programs, and then that sends it down, and then the normal retail investor gets more nervous. So again, these aren't things that have to do with the fundamentals of the business. These have to do with people's emotions and not understanding the math behind it, and then either buying or selling at an inappropriate moment. They don't have a plan. They're just following some emotional turmoil map that they've decided in their head that they're going to try to front run this, and you can't. Listen, we know that we are all going to get back to life as we knew it, but it's going to take a while, right? But as we knew it is actually going to change with the paradigm shift. This is what I'm saying, is that during this period of time of, let's say, volatility, and if you take a look at the volatility, this volatility is going to it's going to stay within this range that I talked about. And now I'm going to add on an additional volatility band, and that is going to be here in the election time, which I'm going to talk about in a minute, and that's part of one of the webinars that I've just scheduled that you can attend. And I said that, unfortunately, real estate is going to be the hardest hit, and I'm going to cover some of those numbers for you in a minute, and this is a good opportunity. And I do see that employment is going to come back, but I'm going to, in just a minute, tell you about how I don't think it's going to come back as we knew it before. It is going to come back, but differently. We are going to see birth rate spikes. We've already started to see those. That will be good long-term for housing in about a year and a half, and over the long term. Now, here is my biggest fear, and I've said this from day one. It is the taxes, and we could have a double whammy. One, we've got $7 trillion that the government just spent, right? And they're talking about a fourth stimulus/relief package. And I'll cover what I see in the works with that. But that is going to increase taxes like we've never seen before. Well, I shouldn't say that. Let me correct myself. We have seen these kind of tax rates before, back in the 1970s when taxes were 80 to 90%. Now here's what's really interesting. There has been the largest divergence of wealth in our country since 1913. If you follow what the spread of wealth is, meaning the middle class versus the lower class and upper class, from 1913 to 1970, we had a pretty even keel as far as the split. And then what they did is they raised taxes. They raised taxes to the 90% levels. Well, who do you think is going to pay the most amount of tax? Most people would say, well, the wealthy do. No, they don't. They hire people like us, and they hire experts to help them legally use the tax laws to reduce taxes, because there's plenty of options out there. The problem is people like us cost money because you're hiring an expert to do it. Unfortunately, if you're a lower income person or even a middle income person, you can't afford to hire an expert. So what do? You go online and do TurboTax, you go online and you do a whole bunch of reading. And unfortunately, when you're a W-2 employee and you're making $25,000 a year, there's not much you can really do to reduce your tax. So that divergence was created in the 1970s, and it spread to where now we have the biggest divergence ever. And what the Democrats are wanting to do is completely change that by going back to a high tax rate. I don't think that they're looking at the statistics. Well, I don't know what they're doing, but I mean, it's not that I'm on one side of the aisle or the other. I'm looking at the pure math. Biden is basically saying that he's going to raise corporate tax rates to 28% and bring back estate taxes, bring back a much higher personal income tax rate. And I hate to say it, it's not going to affect who they think it's going to affect. How do I say that? And because I'm not a politician. I've done tax returns for over 35 years. So when I'm doing a tax return and I hear what the politicians say, I have to disagree because I don't think that it hurts the upper class. They figure ways around it. It is the lower to middle class. And what would you consider today? I'm telling you right now, middle class is even somebody that has $2 to $5 million saved in their accounts. When I'm talking about wealthy, I'm talking about the 20 to 30 to 50 to 100 million plus individuals or families. Those are the ones that aren't going to pay a lot of tax. It is going to hit the lower to middle class. Now what that means is that there's less spending because they make up a majority of the population. They make up a majority of the spend in this country. They're going to spend on new cars, on housing, on clothing. That is the largest distribution of spend in our economics, right? So that is going to have effect. So going back to the market, well, we're going to see a lot of volatility. And what you have to do is step back and understand this is just part of it. I mean, it shouldn't make you feel good when the market goes up, and it shouldn't make you feel bad when the market goes down, because that's just a daily interactive motion that has nothing to do with a 2 or 3 year time horizon. And honestly, if you're investing for anything less than that, I would tell you stick it in CDs. As much as I don't like CDs and I think you're going to lose money against inflation, you're probably better off. You'd probably be happier. You probably don't wake up, one day happy and one day sad. So what I want to do here is I want to overlay something that I've added this week that I think is very important. And again, this is what I'm going to be doing some webinars on. There's phase 1 in the economic mapping, and we're seeing that phase 1, and that phase 1 is going to continue October or so. However, phase 2 is the election and the vaccine, and that is going to go from November all the way into March, April of next year. Then we have phase 3. Well, phase 3 is going to be probably March to April of next year. That's when we're going to see whoever gets elected. If we have current office held, then we won't see as much volatility in the market. However, I do believe we're going to still see some massive, massive changes in the housing market. And then if we go into phase 4, the growth depends on the election and taxation. So what I'm saying is this. While we have this short-term volatility due to the virus, that is going to end towards the first quarter of next year. What will not end and what will have a more traumatic outcome on your finances is what will happen with the election and what will happen with the housing foreclosures. So let's go through a couple factors so you can see why I'm giving you that summary and where all of the facts line up to that phase summary. 1.48 million workers claimed unemployment last week. Week ending June 13th, 767,000 less than the week before and seasonally adjusted at 19 million versus the 25 million. I'm going to show you a graph in about 2 minutes here. This is something that I used back in 1999 crash. I used it back in the 9/11 terrorist attack crash. I used it in the 2000. You have to look at what paradigms shift. So in the technology crash, when the entire market just went in 50% within about 3 months, people that had technology jobs lost their jobs. So what did they do? And then in the 9/11 crash, people lost their jobs. What did they do to reemploy? In 2008, people lost their jobs. What did they do? And you have to make those forward-looking projections. Well, here's my forward-looking projections. About 35% of the people that are unemployed now are going to take a long period of time to readjust. 65% will get back to where they were before. So 20% within a 24-month employment adjustments to new industries. What I'm saying is they're going to retrain. You've probably heard me talk about the Chevy plant and the GM plant in Buffalo, New York. And when I was practicing there, I saw in the early 80s all these people getting laid off when steel went to Europe and car manufacturing went to Japan and Mexico and Canada. And robots started assembling things in a line, and all these unions fought it tooth and nail. But what they didn't understand is they can't fight change. You've got to go with the change and get ahead of the change. You got to see where the change is and then front run that change. And the change in that industry was that no one really wanted to go work on robots and sell robots and update the software on robots, but that's where a majority of those people had to get reemployed, but it doesn't happen overnight. 10%, well, we learned this in the last 3 or 4 crashes. 10% of the current workforce will not employ. Why? Well, they'll just give up on finding a new job. They don't have the fire or the motivation to go retrain into a different industry. They'll stay on Section 8 housing, welfare. They'll stay on unemployment. They'll use up the system. This is just part of our society. So 10% will not adjust. So the expected unemployment rate, and why does this have anything to do with the market? People have to have money to spend, right? They got to have money to spend. So 6.5% versus a 3.5% in February 2020. So here's the predictions that I made originally within my timeline, my economic mapping back in February. You can see I'm in an 80 to 90% accuracy range with where I said the unemployment would go and then re-employ, right? So it's starting to actually happen. But again, the resurgence of the virus is going to have that delay. But I gave myself until August to September for that redeployment on the way back up, a straight line up. Economic decisions. Well, let's look at what the Fed is doing. They're considering extending the tax filing date. I think that's a great idea because there's so many people, we do tax returns, there's so many people that we know that because of the virus, they haven't been able to get out, they can't get documents, they can't get things printed. Not everybody has a printer at home. A lot of people aren't up to speed with technology and scanning and doing some of the other things. So they're talking about this, and I really hope that they do this for the benefit of the taxpayer and the economy. So that's number one proposal. The second proposal, second round of personal stimulus / relief. I don't even know what to call it now, but we all know what I'm talking about. And that's to be announced after the economic data is to be released on July 20th, 2020. So here in about 3 or 4 weeks. Second round of paycheck, that's a mouthful, isn't it? Paycheck protection plant program is for companies under 100 employees and have lost at least 50% of revenues. We'll see if that happens. We'll know on July 20th. And then there's the payroll tax exemption until the end of the year for employees. We're going to know about that too. There's a lot of risks with that. We found out this morning that $38 billion of the PPP program was returned by the large institutions that took unfair advantage of that because they have the ability to go into the market and sell stock and raise capital, and they took a lot of the money out of the PPP. So that is a good thing that they put the money back in there. So if they do offer a second round of stimulus, then that money will be available, plus the $100 billion that's still left in the PPP. By the way, off on a side note, listen, I've seen a couple financial people come out and say, oh, you shouldn't take the PPP. I totally disagree with that. If you're a business, you have employees, you want to make it through this war, take the PPP. And the good thing is it said that originally a lot of these people were saying don't take it because if you don't meet the grant rules where they turn it from a loan into a grant, you have to pay the money back. Well, goodness gracious sakes, that's not a bad thing, right? I mean, number one, you're not personally liable for the loan. Number two is it was set at 1% for a 2-year loan. Now it's extended from 1% to a 5-year loan. Where else are you going to get that? That's a good deal. You take that money, you redeploy it into marketing, hire some good talent, you can make your business grow and flourish, and that will help the economy. So please, don't take I actually heard this guy on TV said, don't take it because it's a bureaucratic mess with the government. Is that a reason not to keep your business surviving? Doesn't make sense to me. Anyway, Fed rates, right? Not changed right now. The Fed is saying that they're not going to raise the rates for possibly 2 years. Average money markets have dropped to 0.15 to 0.25. Right now, while inflation is deflating, that's okay, but be prepared for the groundhog to pop his head out and eat your crops with inflation, right? Average CD rates 1 to 1.25%. And oh, hey, by the way, mortgage rates dropped below 3% for the first time in 70-some years for 30-year mortgages. Let's look at the economic indicator of housing. Right now, the most affected places are, of course, the affected places from the virus. So California, 6.85% of mortgages non-current. Nationally, 7.76% of mortgages non-current. That compares with an average rate typically under 2%. So it's 3 times what the normal current, let me help you understand, current foreclosure, right? Not the forbearance. We're talking about current, and then there's 8.4 million mortgages are in forbearance. Now, here's what's confusing. For most people, they say, well, pending home sales have risen for 8 weeks straight, right? Well, look at it this way. You still have 80% of people employed, right? There's a lot of people that are trying to get out of cities. And you had 3 months of pent up people that they might have had a baby and they were living in a 1-bedroom apartment, right? They were ready to buy a house anyway. Now they can get out. So this pending home sales, I don't think has anything to do with, again, 1 to 2 years of what we're looking at in collapse of the market. Now here's the downside. Okay, now this is a new algorithm, a new decision that we've had to build into our mapping. I want to just take a little quick tangent here. There's so many people that sit there and they look at their investment portfolios and they look at everything that's going on and they'll go, oh, I made this much today, and oh, I lost this much, and oh, in the last 30 days I lost that much. Listen, the bottom line is this. It does not matter what you made 1 day, 3 days, 30 days, 90 days. You're not invested in these things for a short term. I constantly get emails from people going, well, what should I do right now? Well, what you should do is you should have a 1 to 2 to 3 year plan. And if your investment person does not have a 2 to 3 year plan mapped out, and all they're doing is just telling you to hold on, don't do anything, don't sell anything, don't change anything, time to look for somebody else. Because that's probably what the ivory tower of whatever company that they're working for is telling them to tell you. Right? Because they don't know, they've not put together an economic mapping. Now, there are a lot of companies out there that build economic maps, but you got to have proactiveness in it. I saw one economic map from a large financial institution back in February, and I've been checking every single week. They've done nothing at all to change anything within their investment portfolio. So the CFP is to remove the debt-to-income ratio. This is a new part of the algorithm that you have to build out to a ratio of 43%. So what they're going to get rid of the ratio of 43%. Let me explain what this is. Back in 2004, 5, 6, and 7, one of the reasons that we had a financial collapse is you had people making 30 grand a year going out and buying a $1 million piece of real estate. They did not have an accurate way to do that. I just can go upon history and say, I don't think it's a great idea to lend somebody money that's something that they're not checking to make sure that they can afford the money. They're using now this new ratio that's based upon credit spreads and it's based upon what the total cost of the loan is versus can the person actually afford it. Now I'm going to be watching this very closely because that little thing right there makes me pretty nervous. Yeah, right? Does anybody feel 2008 again? Let me put it this way. I don't see the problem within the wrapped around unsubstantiated subordinated mortgages that I saw back in 2008. If anything, what this would do is it would still cause an accelerated housing collapse. Now, if you're on the other end, which I'm teaching people how to get ready to start buying real estate, this might actually help you out. Look to the larger cities and the most affected virus areas to be hardest hit by the foreclosures and price crashes. I'm getting a lot of emails and I'm trying to answer in kind of group emails and saying, look, I'm giving you kind of an umbrella, a top-down view, but it doesn't include every area. I'm saying real estate's going to crash, but it doesn't mean it's going to crash in all areas. If you've got a remote location in Montana, that probably will not take much of a crash because people will actually probably be moving there from the cities to get out of the virus problem that cities incur. But if you're in a large city like a San Francisco, Las Vegas, New York, Dallas, Los Angeles. It also depends upon the political climate as to when they're reopening and what their policies are. So the real estate crash prediction is not like it was in 2008, which affected every single city, state, and county in our country. This is going to have more of an effect on a localized basis. And that is a little easier to predict, in my opinion, because now what we can do is we can localize and we can strategize on the types of real estate that we buy, whether we're going to buy the hard property or whether we're going to buy it through a REIT. Now, my estimates of inflation and deflation, well, we're going to see, because the late state openings and some of the resurgence, we're going to see a V on the inflation. We're going to see it go down because people aren't spending money. So you're going to see a deflation as people adjust. And we're going to see that because the more non-adherence to social distancing and masking, it's going to go deeper into that deflation. Now, it's going to go lower than anticipated return to employment due to high unemployment, civil unrest and protests, and an adjusted estimate of inflationary increases. Here's my estimate. August, we're going to start to see more employment, and then we're going to start to see some inflation. Again, a lot of people have said, well, what if the Fed then comes back and raises interest rates? Honestly, it depends on the election. It depends upon who's running the country. If the Democrats get in, all I can hope for is that they follow the 1929 crash playbook. So far, this administration is following that playbook. Now, again, if you've heard me say it before, Roosevelt, who bailed us out of the 1929 from Hoover's failures, he got into office, he opened up and released and made money policies easy, but then they made a fundamental mistake when it looked like everything was running back. They tightened money policy. We went into what we call the Roosevelt recession back in 1934-35, and then they understood that they made that mistake and they loosened money again, and it bailed them out of that. But again, as long as whatever administration is holding power follows that playbook, I think we'll have a good, solid, straight up with inflation to boot. And again, that's going to make a difference on what you invest in. So stock markets. Well, there's some adjustments in June. The virus resurgence fears, large institutions. So a lot of people emailed me this week going, gosh, what's going on with the market? Is this because of the virus? Actually, a majority of the drop in the market this week was a little bit due to some fears, because that obviously happens. But again, remember what the chess game is here. If large institutions, from when the market went down by 30 to 40% in March, if they rebalanced then, they have a 30 to 40% increase on the stock position. That means that every quarter they are going to rebalance. Well, now that means that they're going to sell down some of the stock and they're going to buy into bonds. That selling of the stock will then trigger a lot of the computer activated programs. So it's not like it was in the old days where you just get an effect of the market prices based upon who's buying and selling. You got all these computers out there watching prices, and when they drop by a certain percentage, they activate selling, accelerating the downside. Then the retail investors look at it and go, oh my gosh, Chicken Little, the world is coming to an end, the sky is falling, and then they sell. And then it accelerates it even more. Institutions love this because, and here's my prediction, you watch at the end of the year, we saw this in 9/11, we saw it in the tech crash, we saw it in 2008. Every single time, these companies make billions of dollars, right? Look at Goldman Sachs. You go back to the 2008-2009 crash when the market just tanked, right? And Goldman Sachs is making tons of money. They're making tons of money. Why? They're trading against public confidence or ill confidence. So all the large institutions are rebalancing. However, I truly believe that a lot of what's going on also has to do with the election and the polls, right? So what's going on with the elections? So we have some corrections to the S&P 500 earnings, and I did some further investigation on what some of the average S&P 500 earnings algorithms are based upon. I uncovered that GAAP earnings under the old system are not including new accounting entries such as other gains, losses, and income. So you got to look at how does the pricing of the S&P 500 come into play. So if somebody looks at the average PE ratio and says, wow, the S&P 500 is overpriced, well, the question is, what accounting system are you using to account for that? Because now there's a new system that other gains, losses, and income is not accounted for in that system. So after I actually did some more of this research, I actually believe now there's probably about a 15 to 20% undervalue in the S&P 500. Now that doesn't mean that's all indexes. I only studied the S&P 500, right? Let's look at the market as of yesterday. We were down about 5.4%. I want to just bring your attention to one thing here, and that attention has to do really with, look at this, we're down 5.4%, and this is in this crazy year where everybody is just on pins and needles. But, well, I don't know why I did that, but let's see. If you look here, look at the 2018 S&P 500. End of the year, down 4.38. The 2017 was up 21.38, and 2019 was up 31. But a lot of people, hey, having a good historical memory on markets and when they adjust is a good, healthy thing. Because this way, if you think, oh my gosh, the world's coming to an end. Look, we were only down, and I want to measure this. This measurement, by the way, here in 514, is from the highest the market has ever been. So we were at the tippy top of that mountain. So if you come back a little bit, Listen, we're still at the apex of that mountain. That's why you don't hear a lot of worry in my voice. I'm more worried about the election. Investment report. Well, here's a couple things that have happened in the last week that I think we should all concern ourselves with. The Fed's capped the top 33 banks from increasing dividends or performance share buybacks. Is this good or is this bad? I think this is a really good action by the Feds. Congratulations, guys. You could have done this in 2007 and 8 and prevented a lot of what happened in 2009. They're taking preventive, forward-looking measures, and I like that. I really, really appreciate that. Unfortunately, back in 2006, 7, and 8, the Feds are like, well, nothing could ever happen, right? And now they're saying, we're going to make sure that these banks are protected. So those people that are arguing with me, because I see some of the chats and the posts, and this is weird, because it's like deja vu, right? Back in 2006 and 7, I was screaming at the top of my stump and saying, real estate is going to take a hit. And I said, listen, it's going to drop 30, 40%. And what's odd is I had the realtors giving me a hard time. They were posting all kinds of stuff and, calling into the radio station back then. And what they didn't understand is that was the best possible opportunity for real estate. Why? Realtors, would you rather sell one $500,000 house or 5 $300,000 houses? It's all about turnover for them, right? And so if the realtors knew how to play the game, they did really, really well. And so a lot of times these realtors will come out, and the real estate companies now are doing it. So a lot of the internet sites are saying, don't worry about real estate, it's always going to go up. Actually, I have to give Zillow some appreciation. About a month ago, I was very critical on Zillow because some of their economists there were predicting that real estate would continue to go up. They're actually doing some cost adjustments on their valuation pages to account for the delay in sales and the depreciation. I think that is the accurate move so that people can really see what's forward looking. So again, I think that the Feds are seeing it, I'm seeing it, and some of the other people are seeing it. Now, there's going to be a huge, and this is what I'm talking about, a paradigm shift, right? So just news this week, Twitter is now going to go to permanent work from home along with Square. You're talking tens of thousands of employees, 50% of Facebook. They're talking about a phase-in where they're not even sure how many people they want back on these big, expensive campuses, and Google, and among others. So while we see there's certain increases in places like Walmart and Amazon, right? That is not office space. That's warehouse and industrial space. That's retail and large big box retail. It's not the main street retail. So again, these are forward-looking things that hopefully your financial advisor is helping you with, because this is how you have to remodel portfolios. There's things like Disney, airlines, hotels. They're still 6 months within reopening and potentially a year to 2 years out. I had this new person email me and said, I want to become a client of yours. And I said, well, I understand why. Well, my financial advisors is telling me, that buy Disney because by the end of the summer I'm going to double my money. Oh, really? Okay, well, it's yet to be seen. But if they reopen, great. But that might be a good 2-year, 3-year play. But look, that is not a 3-month stock, right? Again, I'm going to harp this again and again and again, because I learned back in '99, I learned back in 2009-11. If I don't just keep saying this, people don't pay attention. The election is the biggest risk now, not the virus. It is the election. This is what we have to be prepared for. So we are now, right now, as most of you know, I said back in March, April, I was going to be keeping a 9% cash position. I have not done this since the tech crash. I have not done this since the real estate crash. Listen, we normally keep only a 1% to 2% cash position. Back in March, we reallocated to a 9% hold cash position, giving us the opportunity to buy in over a period of time. Well, we're reducing our cash position, and I'm going to be discussing that, how we're doing it, what the percentages are based upon the models and the portfolios, and that's going to be in the webinar that's coming up. We're also completely changing our REIT allocation. And again, that's going to be in the upcoming webinar, which I'm going to tell you about in a minute. But that is based upon what we're seeing in these dynamics of these companies, what they're doing from work at home, what they're doing with travel, what they're doing with large warehouses and industrial. And keep in mind, I'm going to say it again, in the 1849 gold rush, 99% of those gold diggers didn't make any money. They lived in poverty in the hope of some giant payoff. Whereas the people that sold the Levi jeans, the picks, the shovels, the wheelbarrows, those are the ones that actually made the big money. So today we have to look at that too. Where are people spending their money? How are they spending their money? Where are they working? So we have to understand that it's not the general overall stock market that we believe in at this point. We have to follow this paradigm shift. And that's what we're going to be doing. Is a lot of the stock portfolios we're going to be changing based upon where we are seeing that forward-looking spend. Now, the election is going to affect the stock market without a doubt. It is already affecting the stock market. So here's my prediction. If Biden gets elected, he's already said he's going to bump corporate income tax rates to 28%. Now, why does this matter? Well, back in 2016, when we had the Trump Reform Tax Act, listen, I don't agree with all of the tax reform. So I'm not pumping one side of the aisle. Somebody asked me the other day, they said, what party affiliation are you? Here's the bottom line. I am in the green affiliation. I am in the economic for everybody affiliation. I am in what is going to be better for economics, because I really believe if you hurt people economically, all kinds of bad things happen. Psychological, medical, family abuse, violence, crime, all of those things. So we've seen throughout history, when our economy flourishes, all of those negative things go down. And so I am for the green election. That's what, not green and social, that like save a tree, hug a tree, even though I do like that, but I'm talking about economics green, right? I'm talking about corporate income taxes going to 28%. And what that's going to do is that's going to upheave all of what's happened since in the last 3 years. So again, the reason we had a jobless rate of 3.5%, an unemployment rate of 3.5%, is because they agreed to bring back large companies, Microsoft, Apple, these companies agreed to bring back billions and billions of dollars that they were hiding offshore because we had a very unhealthy corporate income tax rate. Now, it used to be 35%, right? And it's still 28%. So now we're in competition for other countries. We know that that will lose jobs. The estate tax. So right now the proposal is $3 million. Hey, that includes your house, your cars, your furniture, your life insurance death benefit, your IRA. And remember, there's double taxation on your IRAs. So that we're not talking about super wealthy people here. We're not saying, hey, the estate tax limit is anything above $22 million, which it is now, right? You pay estate tax if you have more than $22 million. We're talking about affecting a lot of the upper middle class, even middle class, right? And that's big, that's huge. We have personal income taxes. Now look, hey, I said it before, we have to pay taxes. Listen, we got $7 trillion that we just spent out. But we got to do it in the right way, in the right method, so it doesn't hurt us more than help us. We have personal income taxes, and some of the estimates are going back to a 40 to 45% rate, but we don't know that, right? Because the proposal is if Elizabeth Warren gets to run the Fed, like is the Treasury, like some are proposing, we have no idea what that will affect, and then the domino effect is they have to raise the taxes to pay for some of what the Treasury and the Fed are doing, right? So markets as they relate to political wins. Well, when a Republican wins, here are the facts. These are not my forward-looking statements. These are facts going back to the 1800s. When a Republican wins the presidency, our 2-year average rate of return is 8.3% in the stock market versus 5.8% when a Democrat wins. When Republicans sweep the House and the Senate, the 2-year average is 12.2 versus 3.4. Let me state clearly, so there's no misunderstanding. I am not suggesting in any way, shape, or form that I am going to try to tell you what to vote. You vote with your heart and your mind. What I am telling you, though, is that if you don't get your house in order, if you don't have a good plan, whoever gets into office, you have to have a strategy. So I'm not telling you who I think you should vote for. These are the facts, and we have to be prepared. We have to have a plan B. We have to have specific portfolio strategies, and they must be implemented right now, because the closer you get to the election, the big boys are going to start making the moves against you. And that's what you cannot compete on that playground. So the new investment structure webinar, so that is going to be held on July 1st. That is just, wow, a few days away, right? 6:30 p.m. Limited seats, unfortunately, due to our technology. And so some of you that had joined me back in March and April for a lot of the webinars, you knew that a lot of the technical issues that we ran into because of bandwidth, because of some of the programs that were out there. Well, listen, we've changed our technology, upgraded a lot of the technology, so we're really hoping and praying that we will not have any of those break issues. You know, some people were just like the screen would freeze, and I think back then so many people were at home on the internet during the day. That might have been some of the problem, but some of the companies like Zoom and Microsoft Teams and Zoho, they've all upgraded their systems to accommodate for this internet thing. So now we can get back to doing webinars again. Unfortunately, because of my limited seating in this webinar, because of the technology, it is first come, first serve. And here's what we're going to cover. We're going to cover new strategies in real estate to utilize change in work environments. We're going to talk about the hyperinflation issue. We're going to talk about this new paradigm portfolio strategy. And we're going to talk about the reduction in the cash position and how we're going to be buying in over the next 3 to 4 months. And then we're going to talk about the biggest thing. Again, you want to talk about the light going off, the big warning sign, the red light. It's the election protection tax and market strategies. And we're going to actually reveal the entire new model allocations to accommodate for the virus opportunities. We're going to be doing a second seminar, and here's why, or a webinar. We have been following literally on a weekly basis the feds, the IRS, the Treasury. Everybody is changing the rules on IRAs and RMDs and Roths and the paybacks, and so many people are so confused. And I know this because I see the emails that I'm getting, I see the chats, the posts, the questions online, and there's so much confusion out there that I felt like I needed to put together a webinar so that people understand, number one, what has changed, number one, with the Secure Act, and what do you have to do with your trust to change that? Also, what are these new rollback rules that they just passed in June? And what are the new rules on loans as it applies to 401ks and profit sharing plans? And by the way, for some of you, you might have money sitting in an IRA, and the 3-year spread that they just created may not be the best opportunity for you. It may be a loan. And if you have an IRA, there's no way to take a loan. So we can create a profit sharing plan to utilize that loan provision, but we are analyzing every case one by one because it's like a fingerprint. Everybody has a completely different one. We're also going to talk about what has just changed with these new Roth conversions and this new synchronization opportunity that's available. So let's talk about all the actions now. Number one, get your trust updated to account for the new Secure Act. Attend the webinar. Understand these new rules on IRAs and RMDs. Here's the meeting link. So if you have this, you're watching it on video, you can obviously rewatch it. You can freeze it, and you can then copy and paste that bugger right there into your web browser URL. Here's the second one, new investment strategies, July 1st. Again, if you're watching this on video, you can pause the video, you can write that down and just enter it right into your web browser. Also, if you want to know how to get to it, you can actually register for the webinar before the seats run out by just going to our webpage. Again, it's hhrdm.com, hhrdm.com. And when you're on our webpage, just go ahead over to the right-hand side to the more. You can see this is what we're doing today is a live broadcast. You can pick up those past live broadcasts, but you just hit webinar, hit register now. Boom, there you are. You can get into that webinar before it fills up and learn how to manage what is going on. And a lot of times, people will call, they'll say, well, I'm a client of your firm's already. Should I attend this? Yes, please attend it, because this way you'll understand that while you're not sitting in our office every day, we got 15, 16 people working 60 hours a week, doing all this work in the background to figure out what to do and running the test and running the analysis and then coming up with those solutions. And if you wonder how we're coming up with those solutions, Here, you can attend this webinar. You can see all the facts, the foundations, and what the choices are. This way, when you're talking to somebody in our firm, you'll have a much better foundation and grounding. If you're not a client of our firms and you watch this and your financial planner is not doing this for you, maybe it's time to start looking around for another financial planner. Lastly, if you're not on our webpage or on our YouTube channel, here's my suggestion. Just go into your web browser and just type in search for, HHRDM or H&H Retirement YouTube channel. Well, you're going to see this little screen pop up here, and on the right hand side, just click on that little red button that says subscribe. This way you'll be notified anytime I do a live broadcast. And even if you can't attend the live broadcast, you'll know what the subject is and you can go back and watch it at a later time. Lastly, if you'd like to contact our office and have an initial evaluation done. Now again, we shut all of these initial evaluations off during February, March, April, and most of May. We're going to start allowing these now that we've got everything back into sync after all these changes. So we do have the ability to take on a few more clients now. So if you are interested in having us run an analysis, you can call our office, 844-702-1040. I can't promise you that, number one, we would take you on as a client, or number two is that you'd want to come on as a client. This is a mutual agreement after an analysis is done and a cost-benefit analysis is done. We do give you a 30-minute complimentary phone conference to run through to see if there's a match and see if we can both help each other out. But that is finally opened up again because people have been emailing me and saying, are you guys ready to take on new clients because I really need some help with all this. So that's what you can do. Call our office. They'll schedule you an appointment and you can run through what you're trying to do where you are now. And one of our team members can see if there's any holes, any risks, any things that you can do right now to improve your financial security and future. You can also just go right onto the YouTube page, subscribe to the new videos. Also, we're on Facebook, or anytime you want to go and find out the new events, just go to our webpage, hhrdm.com/events. And that'll be it for today. Have a great day.